Invest in someone yourself, stock, mutual funds, and speculative investments. So continuing from the last slideshow where we talked about bond and real estate as types of investment tools, today we'll talk about three other types: stock, speculative investments, and mutual funds. And this presentation is going to be a little longer just because there are three, and the stock especially has a lot of information to kind of overview. You've seen on TV or in the movies or in the newspaper. There's even a newspaper dedicated to business and investments. There are magazines and journals. Business, investments, finance, it's just a part of the fabric of societies, and it's international, it's all over the world. And so some of the things that you'll learn about and you've been learning about are just exposure to what is a part of life. Maybe you've seen, as you're flipping through stations, there's all the sports channels. Well, there are also all of the business channels. So take a listen. If you've never paid attention before, let's take a minute and kind of hear what it sounds like.
Kinds of things overseas, they keep us safe. And even at home, making arrests, seizing hard drives and computers and information, that's all very helpful. We also get good information.
Here with more. She's got notes.
I got my cheat sheet here.
All right,
You're
cool.
going to be ready at 7 a.m. on
I'll
Sunday.
be awake, yes.
Paying attention?
Absolutely.
Market. Wheat, a bit of a different story. Wheat was drug higher yesterday and continues to trade just a bit higher here today.
Let some of its employees sell their shares. The overall valuation may even be north of that 10 billion figure. Doug McMillan with me now.
All right. So in a little bit, you'll kind of see you'll learn what some of the stuff along the bottom is all about. So next time you notice that, you'll have a little bit of understanding about what it means. So what is stock? Well, stock is a share of ownership in a company. And when you buy a share of stock or shares of stock, which is more typical, you become a stockholder or a shareholder of the company, an owner of the stock. So usually a stockholder owns a very small part of a company. A few stockholders own a large part of a company, but most of us own a very small part of a company that you can go to. If you look at Apple right online, they're investors. If you own Apple stock, there are the reports right there online. If you own stock in McDonald's, they have an annual report. So it's giving financial information to the shareholders, to the stockholders. This is an example of a piece of stock, what a certificate might look like. It's not very often that you actually get a print copy of stock anymore. Most of the information is just stored in an account online that you would take a look at. And you might get a print summary once a month or once a quarter or something, but you usually don't get the actual share of stock. But if you did, this is what it would look like. All right.
The numbers we see every business day can tell us important information about our economy. But where do they come from, and what do they mean? This is stock markets in plain English. Let's get started by talking about companies. There are two basic types. The first is called a private company. Ownership in these companies is private, which means it's not available to everyone. They're usually small to medium-sized, and there are a lot of them, from the bakery down the street to a local trucking company. Private companies are typically owned by an individual or a small group of people. Because ownership is limited, we won't worry about them. Our focus is on companies that offer ownership to everyone. These are called public companies. Here's how they work. Let's say ZipperCorp is a successful company that has big plans. It wants to expand and build a button factory, but it doesn't have enough money. Because it's a public company, ZipperCorp can divide part of the ownership of the company into thousands of pieces and sell them to people like Maya. These are company stock, also called shares. This way, Maya gets to own a small part of the company, and ZipperCorp can raise money for their new factory. Being a public company allows ZipperCorp to raise money from lots of new owners like Maya. Now, Maya's share of the company has a value that typically changes each business day. When ZipperCorp is doing well, the future of the company can look promising. This means that the value of the company and the value of her shares may go up. People like Maya buy shares because they can make money by selling them at the right time. The big idea is to buy shares at a low price and sell them at a higher price. Of course, this is risky because a company's future is hard to predict. For example, people who believe the Button Factory is a good move may want to buy ZipperCorp shares because they think the value will increase. People who believe the Button Factory is a bad idea may want to sell ZipperCorp shares because they think the value will decrease. This means the company's stock has both buyers and sellers. Each business day, shares change hands, depending on how people feel about the company's future value. Some days there's more buying, which can cause the stock price to rise. Some days there is more selling, which can cause the stock price to fall. This is true for each public company in the market. As people buy and sell shares, stock prices can change each day. It's these exchanges, across thousands of companies and millions of people, that make up a stock market. When you see news that a stock market rose, it generally means that across public companies, the value of shares went up more than they went down. This is usually considered good news. People feel good about the future and they're buying shares. Now, because there are thousands of companies, there has to be an easy way to see the big picture across the market. We do this with an index, which is an average of a specific group of stock prices. Indices help us understand if the markets went up or down on a given day by looking at the performance of a group of companies. For example, the Dow Jones Industrial Average is an average of the stock prices of 30 large U.S. companies. The S&P 500 is an average of 500 companies. We hear a lot about stock markets in the U.S., but there are stock markets all over the world. In each market, companies share ownership with the public, and that ownership is exchanged over and over. And we get to see how it all comes together across public companies thanks to indices we see in the news each business day. I'm Lee Lefevre of Commoncraft, and this has been Stock Markets in Plain English.
So stock, the reason people would invest in it is you can make money in it. It's an investment. You can earn dividends, and dividends are the share of the profits distributed in cash to stockholders. So if you own stock in Target, you may get a dividend from them when Target posts its earnings, the profit that it makes at the end of a quarter, the end of a year. They will sometimes set a portion of that aside and pay it out to the stockholders. And it's not every stock that you own that you would receive a dividend for. Some may or may not distribute dividends, so it's just not a guarantee that every company is going to do that. This is an example of McDonald's company, the corporation. If any of you work at McDonald's, maybe you have an opportunity to buy some stock in McDonald's. And this is how often they have paid dividends. You can see they're going to be paying it this month and next. They've paid some in August, they paid some in May, they paid some in February of this year. They paid several times in 2013 and 2012 and so on. And for each share of stock that you own, they are paying out 85 cents, which doesn't seem like a lot. It's 85 cents, but if you own, 100,000 shares of McDonald's, that's a good little piece of money. This is an example of Apple and what they have paid out in dividends. So they also have several in 2014, several in 2013, 2012, and then they had a big gap where they didn't pay any dividends at all from 2012 to 2005. So you can see not every company pays it every year. You can also gain money in an investment through capital gains when you buy stock. The stock returns, and you learned what returns mean. It's the percentage that you are making. I put in parentheses there losses. You can also lose money in stock as well. So the market price is the current price that a buyer, you would be willing to pay for a share of stock. And when you buy that share of stock, if it sells later for a higher price than what you paid, you have what's called a capital gain, which is unearned income that you receive from the sale of the asset. So if you bought a share of stock at $10 a share and then later on in a few weeks or a year, you're able to sell it at, say, $20 a share, you have made a $10 capital gain. If the stock, though, that you paid $10 a share for, you sell it and it sells for only $5 a share, you have made a loss. And you would be out that money. There's no guarantee at all with stocks. That's part of the reason that you can make so much money, is it's a higher risk. There's no guarantee you're going to make your money, make more money, keep your money in the stock market. In the picture on TV of the stock exchange, maybe you've heard the opening bell. People kind of group together up overlooking the floor of the stock exchange, and maybe it's somebody famous, or it's a company that's selling stock for the first time that might be opening the bell, and you'd hear that ding, 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 ding. And can you see who it is that's opening the stock market on this day? You recognize who that is? That's Snoop Dogg, opening the stock exchange. Would you ever think that? Here's another stock exchange, the NASDAQ. It's a newer stock exchange, and it's probably the second most common one that you hear about in the United States. Others are, Tokyo has a stock exchange, London, Kuwait, the Philippines, Nikkei. They're all over the world. So there are multiple stock exchanges where people go to buy and sell stock. And the way that we would do it is we would go to a brokerage firm. They facilitate the buying and selling of stocks in the stock exchange. And overall, there are two main types of brokerage firms. There's a discount brokerage firm, where what they do is they only complete the order to buy and sell investments. They don't give you any advice. They don't tell you if you're making mistakes. They won't tell you that when something should sell. It's just a way for you to buy and sell stock, and you would basically be doing it on your own. And then there are what are called full service brokerage firms, where they would again, buy and sell your stock for you, but you would also be hiring a financial advisor, and that would be a trained professional to help you make investing decisions. So all these different savings tools and investment tools we've been learning about, a financial advisor has gone to college, and that this is what their area of study has been, is they understand all of these different ones, and ones that we're just glossing over here, and many others that we're not even touching on. And you would be purchasing or paying for their expertise to help you make financial decisions for your stock. And these are some examples that maybe you've seen in commercials: Fidelity and Scottrade and E-Trade. And that's what they do. And you can just go right online and set up an account with, say, for example, E-Trade. They're a discount broker. And you get some money transferred into the account, and then you can start making trades. I mean, it's a little more complex than that, but not too much, really. You and I can do this. How do discount brokerage firms make their fees? Well, usually they charge you a fee for completing buy or sell transactions. So you go online, you're going to buy something. Well, they take a fee for that. You're going to go online, you're going to sell something later. They're going to take a fee for that, and it's not a high fee by any means, but they're not going to do it for free. So other fees that they may have, it might be a service fee or an inactivity fee if you're not doing many trades in a year. Maybe a maintenance fees specific to a particular investment. So the total fees are lower, but you have to be monitoring your investment. You have to be doing the research, because they're not going to tell you when you're making a mistake or when you're making a bad decision. You'll be learning that on your own. Full brokerage firm, though, they will help you. They'll let you know when something is good to buy, or that might not be the best time to sell, or they'll give you some advice, and they are compensated for that. You are paying them to do that. So you may be paying, you'll want to, when you get to this point in your life where maybe you're going to hire one, understand how it is that you're going to be paying them. Maybe it'll be a percentage of the investment value, or maybe the amount of the total amount you're investing, or maybe it'll be an hourly rate or a flat fee. Sometimes they're also paid by commission, so they're trying to sell you something and they get paid a commission for that. So just know that there are different ways that they are paid, and you're paying for their expertise, their advice. All right, totally switching gears away from stocks. There is another financial tool called a mutual fund, and that is when a company combines or pools the funds of many different investors. So let's look at all of us in the room as investors. They're going to take all of our money that we want to invest, and then a mutual fund would invest that money in a variety of stocks and bonds, a different combination of stocks and bonds. So not all of the money for an individual is spent, like if you're buying stock, you're buying just one stock. It's all pooled together with a bunch of different investors buying a variety of stocks. So the things that are bought in mutual funds are bonds, stocks, real estate, and speculative investments. And the types of returns that you can get are interest, dividends, rents, and capital gains. So you are kind of sharing the wealth of all the resources of a variety of people, an assortment of people. These are some examples of companies. Maybe you've seen, again, commercials for them, Fidelity or John Hancock or the Hartford, and they will help you purchase mutual funds. Mutual funds have the same kind of a look if you look on the newspaper and some of the financial commercials, or not commercials, TV shows rather. Sorry, it's getting late when I'm recording this. My mind is a little tired. But what you'll see here is they have the name of the fund. This is the company, Madison, and this is the particular fund. They also have symbols, just like the stocks did. They have the closing price. This was on October 31st, and then they have the change. So it went up 27 cents that day. This TFVAY went down 5 cents that day. But they also give here the rate of return, the year-to-date percentage of return, and you can see this Div Inc. Y has a rate of return of 6.9%, and Invest Y has a rate of return of 8.3%. And those are much better returns than what you were looking at when you were researching online for the banks. You were getting a 0.01 or 0.02 rate of return for a savings account. So you can see why people choose to invest in these. It's a much higher rate of return. So advantages of mutual funds is it reduces your investment risk and it saves you time because you're not having to do all the research. Somebody is managing that mutual fund and making the decisions and doing the research to try to gain you money. But the disadvantages is there's maybe higher fees because you're paying someone to do all that research and save you time. A fund. There we go. If she has $150 to invest and she puts it in a mutual fund, that mutual fund then is spreading her investment. It's pooling it in with other people, and it's spreading it out between company A, B, C, D, E, F, and G. And so if C still has a bad year and the market price goes down, and maybe F does as well, there will still be gains from A, B, G, D, and E. And so she has reduced her risk and has the potential to still earn money. If C wasn't so great of a loss that the whole fund lost money, she can still gain money because the other ones have offset the loss of C. So that's a little visual of how that would work. And I think this video does an even better job of, it first talks about stocks, and then it switches to mutual funds to draw a comparison between them. So let's take a minute and watch this.
Earn money without doing anything. Sounds good to me. Seriously though, as you'll see, when you invest, you can make your money work for you. You see, when you invest, your money can work much harder than it does in a savings account, so you may earn even more than just interest. Savings and checking accounts are great for cash you use day to day and for short-term goals or emergencies. But for the big goals, like your education or a home, investing is the way to go. That's when you'll need your money to really work hard for you and grow. Investing is something you'll have to wait to do until you're an adult, 18 or older. But just learning about investing now can help you strengthen your skills for future investing. Have you heard people talk about the stock market? People get real excited about it because stocks are a way to own pieces of big companies. When you invest, you become a shareholder. Think of a company you know and imagine owning some of their stock. Now imagine earning some of the money they earn. Now let's talk about the language of the stock market. Let's look at the HIJK company. The stock is referred to using its symbol, which is usually an abbreviation of the company name. A single stock in company HIJK is called a share, and people usually buy whole shares. A share is a piece of a company, and its value, or share price, rises and falls based on how much people will pay for a share. People will pay money for the stock if they think the company will be successful. If it is, its stock will increase in value, and sometimes the company will also pay its investors a dividend. That's when the company pays the shareholders a part of its profits. The idea behind investing is to pick companies that you think are going to grow and increase in value. The trick is to buy shares when the price is low, so you can sell them when the price is high. That's how you make money on your money. This is a stock listing you might see in a newspaper. Roll your cursor over this listing to learn more about what each column means. Do you like riding roller coasters? How about jumping off the high dive? That's taking a risk. When you invest, you're also taking a risk. After all, if a company does well, its share price will increase. If the company doesn't do well, the company's stock can lose value. What makes an investment risky? Lots of things, and sometimes they have nothing to do with the company itself. World events and trends can influence the price. So can government taxes and policies. Even consumers' and investors' optimism about the future of the economy can affect overall prices. So before you invest, do your homework. Study a company before you buy their stock. Look at what's happening in the US and the world. Ask yourself if those events will affect the company you want to invest in. Investing isn't for everyone because there's so much risk involved. Plus you have to be at least 18 years old. Still, it's good to learn as much as you can, even now, so that later, if you do invest, you'll know what you're doing. And if you ever need help with investing, you can always talk with an investment advisor. Now let's look at two tools that people use to decide whether they want to invest or not. The Dow Jones and the Nasdaq stock indexes. Maybe you've heard of them, and that they go up and down. What does that mean? Well, both the Dow Jones and the Nasdaq indexes are simply groups of very popular stocks. The Nasdaq stocks are mostly in technology, while the Dow Jones includes stocks of very big US companies across many industries. So when you hear that either the Dow or Nasdaq is up or down, it means, in general, that a number of popular stocks that people follow are either going up or down. So for example, if the Dow or Nasdaq are up, that means that generally the very popular stocks are increasing in value. When you buy shares of a company, you pay a certain price for each share. When you decide to sell the stock, you sell it for more, less, or the same price you paid for it. When you sell the stock for more than you paid for it, you make money on your investment. Now, let's try some activities. If you'd like to get into the stock market, but you don't feel comfortable studying companies and how they're doing, there's still a way to invest. They're called mutual funds. When a group of people put their money together and pay a manager to buy stocks from many different companies, they've started a mutual fund. When you buy into a mutual fund, you become an investor in many different companies. As a result, you don't have to watch the ups and downs of each stock. You just follow the overall value of the mutual fund. The idea behind a mutual fund is that it spreads risk. That means that if the fund invests in company A and its stock loses value, then another company in the fund, company B, may, on the same day, increase in value. The gains in Company B may even cancel out the losses in Company A, so you might not lose anything. Do you see how, by spreading the risk, the mutual fund can act as a buffer against losses? Of course, not all mutual funds gain in value. Sometimes more stocks in a mutual fund lose value than gain, and the value of the fund goes down. The stock market makes no promises. Remember, if you don't want to risk losses on your money, you can grow your money safely in savings accounts, certificates of deposit, or money market accounts. When you sell a stock at a higher price than what you paid for it, you make a profit. The financial term for that profit is called a capital gain. Capital refers to the money you use for investing, the money you start with. The gain portion of capital gain refers to the money you earn on your investment if you sell the stock for a profit. If you lose money on the sale of your stock, then the term is called a capital loss. These are good words to remember. Just imagine when the time comes to sell an investment, like a stock or a mutual fund, for a profit. You can very proudly say, I had a capital gain. Cool, huh? Now let's try some activities. So now you've learned a thing or two about investing, and how dividends and capital gains can help you make money for your big goals in life. Reaching those goals will take time. The stock market doesn't increase every day, but over the last 50 years, stocks have generally gained value and earned investors more money than if they had invested in safer savings accounts. The more time your money is invested, the greater your chances to earn more money. You and I can start now with savings accounts. But when we turn 18, we can think about buying stocks. Time is definitely on our side. If you've completed...
Well, hopefully this helped you to understand and to see a little differently with a little more visual of stocks and mutual funds.